Very interesting and confusing tape yesterday, but things are looking a tad more normal as we kickstart today's EU session. In terms of overall risk sentiment, things are cautiously optimistic right now, if I can be as agnostic as possible. Looking over to some specifics in the markets right now, let's start with equities. Mostly choppy during Asia Pac following what was a very ugly session for US equities. I mean, big downside in the S&P, big downside for the Nasdaq. We also saw some downside playing out for the likes of the DAX, the likes of the Euro stocks. It was an all-out ugly session, mostly led lower by technology as well as communications, with the biggest driver being Nvidia seeing quite a big push lower. The markets didn't like the news that AI chips, the chip sales to China were reportedly stalled by the US due to a security review. That's also led to Chinese buyers basically just holding back from placing new orders. So that makes a lot of sense. And that's why the markets, that's why Nvidia got slammed a little bit. But even though technology got slammed, it wasn't all out negative. We actually had energy doing really well with the pop to the upside in oil prices. We had materials up, industrials up. So we did see a little bit of a cyclical and value rotation yesterday. In terms of where we are today, again, looking cautiously optimistic, but despite the upside that we've seen in Asia, we are still nursing losses from yesterday. So that's something worth watching, and obviously keeping a close eye on Google earnings coming up after market as well. In terms of FX, very contained right now, apart from continued weakness in the yen. There were some earlier reports out that hedge funds are basically piling back into short bets on the yen as we head into this weekend's Japanese election. If you quickly take a look at the options market agrees right now. If we go to dollar yen, you can see that we've had quite a big push to the downside in implied volatility. Implied vols have come down and risk reversals have gone up. So, as the risk of intervention, as those threats have basically gone cold a little bit, we have seen a little bit of that risk premium die down with volatility coming lower, risk reversals going back up. Look, in my opinion, given the ongoing risk of intervention, it does feel very risky to try and chase dollar yen higher right now. But it's tough to argue with longs as well after you have the PM, the weekend, basically talking up the weakness in the yen, saying that it's actually a very good thing to have such a weak currency. I mean, talk about an own goal. They've been struggling with this weakness for such a long time. It doesn't help if she comes out and says, yeah, well, it's actually not a bad thing. It's actually a pretty good thing. So not surprised to see the markets react this way after the weekend, but the higher and higher we climb, once we get into the danger zone, the risk of intervention is there again. In terms of the election, look, if she wins by a massive landslide, that's probably going to put further downside pressure in JGB's upside and yields. That should translate into weakness for the yen. But again, when do we see intervention? When does the MOF step in? We just don't know. Obviously, we'll be watching those danger zones, and the election, obviously, reaction on Monday will be key for us to keep on the radar. Apart from that, the Kiwi saw a little bit of marginal weakness earlier in the session on the back of the employment data. Now, to be honest, the data wasn't as negative as the price action suggests, because yes, even though the unemployment rate did tick up to 5.4 from 5.3, most of that could arguably be driven by the higher participation rate. Apart from that, jobs growth came in really solid at 0.5. So I honestly didn't see the negativity that was priced into the Kiwi dollar. I still think the Kiwi is well placed for more upside throughout the year, given that the market, apart from the RBA, thinks that the RBNZ could be another bank that is lining up potential hikes this year. Again, we would have to see the data corroborate that. Right now, we've had some positive data, but today's mixed data didn't do the Kiwi any favors. If you take a look at the City Economic Surprise Index, the majority of data has been pushing up, hence why we've seen rate pricing for hikes increase. But again, if we want to see that sustained trend playing out, we really do need to see some data coming out solid as well. Now, in terms of other FX movers to watch, the Aussie still the strongest today, just as it was yesterday, obviously on the back of the RBA policy decision. Now, this bank completely surprised me yesterday. I was in the hold camp. I honestly did not think the bank had it in them to hike rates yesterday. Not only did they hike rates in line with expectations, but they also provided some pretty stern hawkish guidance by penciling in a higher cash rate compared to what the markets had priced in ahead of the meeting. We can see here markets are comfortably pricing in close to 40 basis points of tightening by the end of the year, so very close to 2 more hikes. Now, apart from the statement being pretty hawkish, it did feel like Governor Bullock tried to just ease up on some of those hawkish bets or rein in those hawkish bets a little bit by saying that they haven't made any commitment yet, pushing back against the idea of autopilot hikes, but the markets, again, still pricing in comfortably close to 40 basis points. Look, even though this has boosted the Aussie again, I am reluctant on chasing it higher here. We've seen a huge buildup of crowded longs in the Aussie dollar from a positioning side. Now, this does not mean we should sell it just because institutions are long it. They are long this currency for a very good reason right now. But it does mean that if we were to see a negative catalyst on the horizon, the risk of a squeeze does increase the more and more stretched this becomes. So that's just something worth keeping in mind. Now, turning to commodities, oil had a great day yesterday because there was some news coming out that the US military shot down an Iranian drone. There was also news that gunboats approached a US flagged vessel in the Strait as well. That obviously saw upside in oil. It has traded fairly mixed or flat throughout the session so far. Apart from that, gold and silver continues their rebound, more so gold compared to silver. Obviously the move looks smaller, but from a percentage point of view, silver still up more. Look, whether this is the new start of a sustained rally or whether this is a dead cat bounce is still up for debate. As we mentioned on Monday, though, these types of flush outs have happened before. If you quickly take a look at your daily chart, if you go back to 2020, we had a very similar situation where markets went absolutely parabolic, followed by a huge flush, then a pop, and then a fade and a fizzle lower. Similar story to 2011. We actually did trade to a new all-time high back then before we flushed even bigger, right? So we had parabolic move, that first flush, traded to all-time highs, and then the big move lower came. Now, again, I'm not saying we are going to follow the exact same pattern, but it would be risky for us not to use these prior examples as a way to just interpret the type of price action what we're seeing. Basically, just be careful is what I'm trying to say here, because even if you take a look at implied volatility, even though we've come down quite a lot, we're still at crazy high levels, right? So yes, if you look at gold implied vols right now, we went from a high of 37 down to 33, still crazy high. For silver, it's down to 75 from a high of 90. So still crazy levels, which still warrants a lot of caution. Now, apart from that, not a lot else to talk about. Crypto was another ugly one. Geez, like this market just cannot catch a break. Another low for crypto, for Bitcoin at least, trading back down towards November 24 levels. Look, the same word that came to mind last week is coming to mind again today, and that is fragility, right? If you have risk on, Bitcoin's down. Risk off, Bitcoin's down. Gold up, Bitcoin down. Gold down, Bitcoin down. Equity, same story. Nothing seems to be able to lift this market from the lows. Arguably, if you are long in the long term, you probably see this as a potential bargain. But momentum is still, if I just hide this for a second, momentum is still very much bearish on this market. So, just have your wits about you when it comes to this market right now. Now, in terms of the day ahead, we've got a couple of data points to look forward to. We do have the ISM Services PMI coming up a little bit later. Now, just a reminder, the manufacturing PMI came in pretty solid earlier in the week. We had new orders jumping from 47 up to 57. Overall, just a very solid print. Even the employment index, even though we didn't push back into expansionary territory, we did push up from 44 all the way up to 48. So that was quite a promising one to look for. In the session ahead, we've got the services. Obviously, services, a much bigger share of the economy, so one that will be a little bit more interesting and important for us to watch. And then we also have ADP employment data that is set for release a little bit later as well. Apart from that, and in terms of the BLS, we did obviously have the government shutdown ending yesterday, but we still won't be getting the NFP data on Friday as the BLS confirmed on Monday. It is frustrating, but it is what it is. Let's just move on. Apart from that, further eyes will of course be on the ongoing geopolitical situation if we see new developments there. Also keep an eye out a little bit later for Google earnings coming up after market. That is going to be a big one to watch, especially given all of the stress that we've seen in technology over the past 2 weeks. And that is that for the session ahead. So I hope you guys will have a fantastic day ahead. And as always, any questions, don't hesitate to let me know.